Gold hit $5,589 per ounce on January 8, 2026, and 3 months later sits at $4,683. That is a 16.2% pullback from the all-time high. Every gold-related forum, every retirement-focused subreddit, every comment section on every gold ETF article published in the last 6 weeks contains some version of the same question. Did I miss it? Did the rally end? Should I sell now and lock in what I have? The exact same question was being asked in October and November of 1979, when gold had pulled back from approximately $444 to $385 after a ferocious summer run, a 13.3% pullback. Two retail investors sat at two different kitchen tables on opposite sides of the United States in November 1979, looking at the same financial pages. Walter Reinhardt, 52, a machinist in Cleveland, Ohio, who had bought 60 ounces in 1976 at $130 an ounce, sold every ounce on November 19, 1979 at $392. Mariana Esposito, 47, a dental hygienist in Tucson, Arizona, who had bought 40 ounces in 1977 at $148 an ounce, held every ounce through November and December 1979 and into 1980. Within 73 days of Walter's sale, gold reached $850 per ounce. Within 90 days of Walter's sale, gold completed the move that converted a $130 entry into a 900% gain. Walter walked away with $23,520. Mariana, when she finally sold the last of her position in 1980, walked away with $34,000 on a smaller original purchase. Same era, same news headlines, same anxiety. 2 doors, 1 choice. The trap that caught Walter in 1979 is open again right now, and almost nobody who is feeling the same anxiety in 2026 recognizes the room they are standing in. My name is Ban. I have spent 4 months reconstructing the gold price action of 1979 and 1980 across primary sources: the World Gold Council's Historical Price Archive, the Federal Reserve's FRED database for inflation and yield data, the Wall Street Journal microfilm archive at the New York Public Library covering the relevant trading sessions, the contemporaneous CFTC commitment of traders' reports from the Commodity Exchange in New York, and the academic work of Roy Jastrom in his book The Golden Constant, updated through the 1980 cycle. I am going to walk you through what Walter saw on the morning he sold and what Mariana saw on the morning she did not. The two of them looked at the same data. They reached opposite conclusions. The reason matters. The reason is the same reason most retail gold holders right now in April 2026 are sitting at their own kitchen tables asking themselves whether to do what Walter did. If you hold gold, if you were watching the spot price daily, if the pullback from January is starting to feel like the rally has exhausted itself, stay with me until the end, because the structural conditions in 2026 are stronger than they were in 1979, not weaker. And the framework that destroyed Walter's outcome is the same framework being installed in retail minds right now. Subscribe to the channel. Hit like. Share this video with the person in your life who is closest to making Walter's choice. Most people will not see this video in time. The ones who do will have the chance to see what Mariana saw. Here is the framework. Every major gold cycle in the post-Bretton Woods era has run through the same 5-phase structure. Phase 1 is accumulation, when professional money builds positions while retail is uninterested. Phase 2 is breakout, when a fundamental catalyst, usually monetary instability or geopolitical crisis, pushes price through a multi-year resistance level. Phase 3 is the public participation phase, when retail floods in and price advances rapidly. Phase 4 is the blow-off top, the final parabolic move that exhausts buying power. Phase 5 is the corrective phase, which can last years. The trap that destroyed Walter in 1979 was that he sold during what looked to him like Phase 4, the blow-off top, when the move he was actually inside was still in Phase 3. He confused a Phase 3 pullback for a Phase 4 exhaustion. The pullback he sold into was the consolidation before the parabolic move, not the parabolic move itself. By the time gold reached $850 on January 21, 1980, the parabolic move had only just begun. The actual blow-off was the January 1980 spike. Walter sold during Phase 3's interior breath. The move he sold out of had 900% of its run still ahead of it. Mariana saw the same chart Walter saw. She read the same financial press coverage. She listened to the same radio commentators predicting that the rally was over because the Federal Reserve was about to raise rates aggressively under its new chairman, Paul Volcker, who had been appointed in August 1979 and was openly committed to crushing inflation. The conventional logic in November 1979 was airtight. Aggressive Fed tightening means higher real yields mean lower gold prices. And gold's run from $100 to $440 had already discounted everything monetary stress could deliver. Sell now, take the gain, move into Treasury bonds yielding 15%. That was the consensus in November of 1979. It was wrong. And the reason it was wrong is documented in the Wall Street Journal trading session reports of late November and early December 1979. Gold was being bought, not retail, by foreign central banks, by Middle Eastern sovereign accounts, and by a category of buyer the contemporary financial press did not have a name for: institutional investors hedging the systemic risk that the dollar's reserve status was eroding regardless of what the Fed did to short rates. The buying did not show up on retail brokerage screens. It showed up in the COMEX delivery notices and in the Bank of England's weekly gold transfer ledgers. Mariana could not see those documents. She did not need to. She had read Roy Jastrom's Golden Constant, published in 1977, available at her county library, and she knew that gold cycles historically completed their advance phase 5 to 7 years after the initial breakout, not 18 months in. She held because the framework she had read told her that 1979 was not late in the cycle, it was mid-cycle. Here is the part Walter did not see, and almost nobody is talking about right now. The framework Walter believed, the framework that told him the rally was exhausted, was being installed in his mind by the same financial advisory complex that benefited from his selling. Walter's broker earned a commission on the sale. Walter's broker earned a commission on the Treasury bond purchase Walter made with the proceeds. Walter's broker earned ongoing trail commissions on the bond fund Walter rolled the proceeds into in 1981. The broker's incentive structure rewarded Walter's exit from gold and Walter's entry into the next product the broker could sell. Walter did not have a financial advisor in 1979, in the modern sense. He had a stockbroker at a regional firm in Cleveland who serviced his account on a transactional basis. The broker did not lie to Walter. The broker simply repeated what every other broker in 1979 was repeating, which was the institutional consensus, which was wrong. The same structural dynamic exists in 2026. Less than 0.5% of registered financial advisors in the United States hold gold in their personal portfolios above 5% of net worth, according to industry survey data published in the past year. Gold pays no commission. Gold pays no 12b1 fee. Gold pays no management fee to the advisor. Equity mutual funds and bond funds pay all three. The advisor's recommendation against gold is not necessarily dishonest, it is structural. Walter's broker in 1979 gave the same advice for the same reason. The framework that told Walter to sell was not random. It was manufactured by an industry whose revenue depended on Walter's selling. Now extend that observation forward. The retirement industry today manages approximately $40 trillion in tax-deferred accounts in the United States. Of that, approximately 0.5% is allocated to gold or gold-related vehicles. The remaining 99.5% sits in equity funds, bond funds, target date funds, and money market accounts, every one of which pays a recurring fee to the advisor or the platform. If retirement allocations to gold rose from 0.5% to even 3%, still well below the 5 to 10% allocation that institutional consultants like Goldman Sachs and Bridgewater have publicly recommended for ultra-high net worth clients. The revenue redirected away from advisor fees would exceed $800 billion over a decade. That is not a number any advisory industry is going to cheerfully recommend its clients pursue. The framework Walter inherited from his broker was not a neutral technical opinion. It was the product of a revenue model that depended on Walter believing it. The same revenue model is operating right now around every retirement account in America. Your advisor is not the villain of this story. Your advisor's compensation structure is the variable. The variable has not changed in 47 years. What has changed is that Walter did not have access to the documentation. You do. The Investment Advisor Association membership survey is publicly available. The expense disclosures required under Rule 12b-1 are publicly available. The percentage of registered investment advisors who personally hold gold above any meaningful threshold is publicly trackable. The framework can be inspected. Walter could not inspect his framework. You can inspect yours.
Now let me show you what each of them did week by week through the rest of the cycle. November 1979. Walter sells at $392 per ounce. Mariana holds at $392. December 1979. Gold trades sideways between $380 and $440. Walter feels validated. The rally does seem to be done. He moves the proceeds into 10-year Treasury bonds yielding 11.8% and into a balanced mutual fund recommended by his broker. Mariana watches the consolidation and reads more. She subscribes to a newsletter called Silver and Gold Report, published out of Phoenix, that costs $48 a year, an expense her husband questions repeatedly through the year. Late December 1979 into January 1980. The Soviet Union invades Afghanistan on December 25th. Iran continues to hold the United States Embassy hostages, the crisis having begun on November 4th. Oil prices, which had doubled during 1979 following the Iranian Revolution, push higher. Inflation, already at 12%, accelerates. Gold breaks above $450 in early January and reaches $500 by January 8th. By January 11th, gold reaches $600. By January 17th, $700. By January 21st, $850 per ounce. The blow-off top arrives in a 14-day vertical move that compresses what should have been 6 months of price action into 2 weeks. Mariana sells 30 of her 40 ounces between January 18th and January 22nd at an average price of $798 per ounce. She holds the remaining 10 ounces through the subsequent crash to $300 in 1982, and through the entire 18-year consolidation to 1999, finally selling her last ounce in 2007 at $685 during the financial crisis run-up. Her total proceeds across the cycle were approximately $34,000 on an original investment of approximately $5,900, a return of 476% over 30 years. Not adjusted for inflation, that figure is misleading. In real terms, her purchasing power roughly doubled across the period. Walter's outcome on the same time horizon was different. The proceeds he moved into Treasury bonds in 1979 performed adequately into 1981. The bond fund his broker rolled him into in 1981 performed catastrophically through the early 80s as long-duration bonds collapsed. By 1983, when Walter finally exited the bond fund, he had recovered to approximately $20,000 on the original $23,500 sale proceeds. A real terms loss of approximately 40% given the inflation of the intervening years. Walter died in 2016. The gold he sold in November 1979, if held to the date of his death at $1,950 per ounce, would have been worth approximately $117,000. The difference between Walter's actual outcome and Mariana's actual outcome was not a financial choice. It was a framework choice. They sat at kitchen tables on opposite sides of the country reading the same headlines. One of them had read Jastrom, the other had listened to his broker. The two specific numbers to watch in 2026 instead of the daily gold spot price, the 10-year Treasury inflation-protected security yield, currently approximately 1.8%, and the gold to Federal Reserve balance sheet ratio, currently approximately 4.2%. The TIPS yield is the modern proxy for what was called the real interest rate in 1979. When the TIPS yield falls below 1.5%, gold has historically advanced. When it falls below 1%, gold has historically advanced sharply. The yield's current trajectory is downward, retreating from a March peak of 2.13%. The gold to Federal Reserve balance sheet ratio measures the dollar value of all above-ground gold relative to the size of the Fed's monetary base. The ratio has been declining for 53 years as the monetary base has grown faster than gold can be mined. When the ratio falls below 4%, it has historically marked the late stage of Phase 3 and the transition into Phase 4. The ratio is currently at 4.2 and has fallen sharply over the last 2 years. Both numbers are publicly available on the Federal Reserve's website. Both are updated weekly. Less than 1 in 10,000 gold investors track either one. Your financial advisor will not show them to you. They are not on Yahoo Finance's default chart for any gold ticker. The numbers exist. They are free. They are not promoted.
Now here is the part the Walter mind installs and almost nobody is willing to interrogate. The pullback from 5,589 to 4,683 is 16.2%. The pullback from 444 to 385 in October-November 1979 was 13.3%. Both are similar in magnitude. Both occurred after a multi-year advance. Both produced the same emotional response in retail holders. The rally is done. Take what you have, the next move is down. In 1979, the move that followed the 13.3% pullback was a 120% advance over 73 days. The structural conditions in 2026 are stronger than they were in 1979, not weaker. The Federal Reserve balance sheet is 68 times larger in nominal terms than it was in 1979. United States federal debt as a percentage of GDP is 123% versus 33% in 1979. Central bank gold purchases reached an all-time high in 2025 at over 1,300 metric tons, more than double the average of the prior decade. The Bank for International Settlements upgraded gold to a Tier 1 asset under the Basel III framework in 2023, meaning physical gold held by banks now counts at 100% of its market value toward regulatory capital, the same as cash and government bonds. None of these conditions existed in 1979. The dollar's reserve currency share has fallen from 71% in 2000 to 56.8% according to the IMF's most recent COFR data. The structural backdrop is more favorable to gold in 2026 than it was in 1979. The pullback feels the same. The rooms are not the same. For instruments, the 4 to consider with a clear note: this is not a recommendation, this is a description of what each instrument does. SPDR Gold Shares, ticker GLD, is the largest physically backed gold exchange-traded fund in the world with approximately $150 billion in assets under management. Deepest liquidity, lowest bid-ask spread, the default vehicle for institutional gold exposure with no tracking error issues. iShares Gold Trust, ticker IAU, is mechanically nearly identical to GLD with a slightly lower expense ratio of approximately 25 basis points versus 40 for GLD. The fee differential matters when held inside a tax-deferred account across a multi-year cycle. Both GLD and IAU are eligible for traditional IRAs and Roth IRAs without structural limitation. For investors aged 45 to 65 with retirement accounts as their largest pool of capital, the IRA wrapper is the structural choice that determines what the cycle's return actually puts in your pocket. Gains on physical gold or gold ETFs held in a taxable brokerage account are taxed as collectibles at a maximum federal long-term rate of 28%. The same gain held in a Roth IRA is never taxed. Aberdeen Standard Physical Gold Shares, ticker AAUU, holds physical gold in vaults outside the United States banking system entirely. For investors with concerns about systemic structural integrity during a Phase 3 to Phase 4 transition, AAUU is the institutional vehicle that holds metal outside the domestic system. Lower assets under management, slightly higher bid-ask spread, fully IRA eligible. Van Eck Gold Miners, ticker GDX, is the leveraged play. During the 2008 to 2011 cycle completion, GDX gained over 200% from the March 2009 bottom to the September 2011 peak, while gold itself moved 159%. Mining companies whose extraction costs stay roughly fixed see profit margins expand sharply when the gold price rises. Position sizing for miners should be smaller than for physical gold because the leverage cuts both directions, and miners are stocks subject to equity market drawdowns. The Walter trap can apply to miners specifically. Investors who hold miners through the Phase 3 pullback will see them down more than physical gold. Walter's actual mistake, selling at the pullback into Phase 3's interior breadth, applies more violently to miners than for physical gold. Hold them only with full understanding of the volatility differential. Walter Reinhardt sold 60 ounces of gold on November 19, 1979 at his broker's office in Cleveland for $23,520. He drove home, put the check on the kitchen table, and told his wife the rally was over. He moved the proceeds into treasury bonds and a balanced mutual fund. Walter's name appears in no document anyone reading this can verify. He is composite. He is the version of Walter who lived in every neighborhood in every American city in November 1979, sitting at his own kitchen table, doing what his broker told him made sense. The actual Walters of 1979 did not appear in newspapers because they did not do anything newsworthy. They simply sold during the interior breadth of Phase 3 and missed the parabolic move that followed within 73 days. There is no monument to them. There is no historical record of their names. They are the structural majority of every gold cycle's third phase. Mariana Esposito's name appears in no document either. She is the smaller composite, the cohort that read Jastrem, that held through the breadth, that captured the parabolic move in January 1980. Her cohort exists. Their names are not famous. They simply did not sell when the framework around them said sell. They held because they had read a different framework. The framework was not a secret. Jastrem's book was on library shelves in 1979. The book is on library shelves in 2026. The structural conditions that produced the 1980 parabolic move are stronger now than they were then. The pullback from 5,589 to 4,683 feels the same as the pullback from 444 to 385. The room you are standing in feels familiar to anyone who is paying attention. The framework you choose in this room determines which composite you become. Walter and Mariana sat at the same chart. They reached opposite conclusions. They lived opposite financial lives. The information was the same. The framework was different. There are two doors in this room. One choice. This is BAN. Two doors, one choice.